In 2020, a regular Indian man from Bengaluru, let's call him Ravi, entered the stock market with 50,000 rupees. Ravi did not study companies or understand how markets worked. He invested because a friend told him one simple line: "This stock will double in 2 weeks." 2 weeks later, the price fell sharply. Ravi became scared. He sold his investment and left the market. What he did not realize was that over the next few months, the price recovered and went higher. Ravi did not lose money because the stock market is bad. He lost money because he did not understand how it works. The stock market is like a machine. If you don't understand the machine, emotions take control. Many people believe the stock market itself is risky. In reality, not understanding it is the real risk. Fear and greed create losses more often than bad companies do. Once the basics are clear, the market becomes much less frightening. Imagine a small chai shop near a busy road. The owner wants to open another shop but needs money. Instead of taking a loan, he decides to share ownership. He divides his shop into 100 equal parts. Each part represents 1% ownership. If you buy one part, you own 1% of that business. If the shop earns more money and grows, your share becomes more valuable. That ownership part is called a stock. A stock is simply a small piece of a real business. The stock market is just a place where these ownership pieces are bought and sold. When a company needs money for the first time, it sells shares to the public through an IPO. This is when the company raises money. After that, people buy and sell those shares among themselves every day. The company does not earn money from these daily trades. Stock exchanges like NSE and BSE exist to make this buying and selling safe, organized, and transparent.
The answer is very simple. There is no fixed price. The price you see is the last deal between a buyer and a seller. If many people want to buy a stock and very few want to sell, buyers offer higher prices and the stock goes up. If many people want to sell quickly, they accept lower prices and the stock falls. Prices move only because of demand and supply. But there is another important idea to understand. The stock market does not focus on today. It focuses on the future. Investors are always thinking about what a company will earn in the coming years. Sometimes a company reports good results, but the stock price still falls. This happens because investors expected even better results. The market moves based on expectations, not emotions or news headlines alone. Now think about two people in the same market. Ravi wanted quick profit and sold in fear. Another person, let's call her Ananya, took a slow and steady approach. She invested in well-known companies or market index funds. She did not check prices every day. She invested regularly and stayed invested for years. Both faced the same market ups and downs, but their results were very different. Time and patience made the difference. People earn money in the stock market mainly in two ways. One is when the price of a stock increases over time. The second is through dividends, where companies share part of their profit with owners. For most long-term investors, wealth grows mainly through rising stock prices as businesses grow over the years. Most losses in the stock market do not happen because people choose the wrong stock. They happen because emotions take control. People buy when prices are high because of excitement. They sell when prices fall because of fear. Some trade too often because they are bored. The market is strange in one way. People rush to buy when prices are expensive and rush to sell when prices are cheap. This behavior creates losses. There are also common myths. Many believe they need a lot of money to start investing, which is not true. Small, regular investments matter more than large amounts. Some believe the stock market gives monthly income like a salary. It does not. It helps money grow over time. Others depend on tips from social media, not realizing that most tip sellers earn money by selling advice, not by investing themselves. For beginners in India, the safest approach is simple. Understand the basics before investing. Start with diversified investments instead of betting on one stock. Invest regularly and patiently. Never invest money needed for rent, emergencies, or short-term goals. Check progress once a year, not every day. The stock market does not reward speed or luck. It rewards patience, discipline, and understanding. In the end, the stock market is not a place to gamble. It is a place to own businesses and grow along with the economy. Once you understand how the system works, fear reduces, confidence grows, and investing becomes a calm, long-term journey instead of a stressful race.
But here's the part most people never stop to look at. Over the last many years, the market has quietly moved through wars, recessions, pandemics, political changes, and global crises. Headlines changed every day. Fear came and went. Yet strong businesses continued to grow, adapt, and survive. Some companies that once looked ordinary went on to create massive value for those who stayed patient. So how did the market actually grow during these years?
By SEBI reveals that over 9 out of 10 individual traders in the F&O segment continued.
Prices have crashed ahead of union budget.
We will look at real market history. The future of the Indian stock market will not be decided by headlines, but by how businesses grow over time.
Index fell by over 6%. This index has India's top 10 IT companies, Infosys, TCS, HCL, Wipro, you name it, they were all in the red today. In fact, in the past couple of days, these...
If this helped you understand the market better, share and subscribing to Money Formula. More real stories, real data, and real investing logic coming next.